Good evening, everyone, and welcome to tonight's webinar. My name is Matthew Mclure, and I'm one of the executive dealers and currency experts at Lumon Pay, an international payment provider. Thank you for joining us for this evening to discuss the fallout of the recent autumn budget and how this might influence your personal finances and financial markets ahead. Tonight I'm joined by some real experts in their fields, a select panel who I will shortly hand over to for their introductions. But we do want this webinar to be as interactive as possible, so please use the question box to raise any questions that you might have, and we'll do our best to get to them. We might not always get round to them, but yeah, do feel free to put some in there, and we'll share some contact details with the panelists afterwards. We have had some questions submitted to us before the session, so we'll go through those initially. So initially, I'll hand over to one of the panelists just to introduce himself. Robert, if you'd like to go first.
Yep. Hi, everybody. Thank you, Matthew. It's nice to be called an expert, so I appreciate that. My name's Robert Marler. I'm a Chartered Fellow, which is the highest level of professional standards and qualifications that you can get in the UK. So I recently joined SJB Global. I've had about 25 years of experience within financial services. It was one of the first jobs I had from leaving school. And just a little bit about myself, I'm a single parent with 2 children. It is fireworks night tonight. They are excited downstairs, so if they do run in, that's the reason why. But I'll pass over to Daniel. Thank you.
Hello, thanks for joining us tonight. Hope I can answer a few of your questions, which I know that some of you have already sent in. Yeah, absolutely. I'm one of the senior advisors here at SJB. I've been with them since the business started back in 2017. I've actually been in the industry for a little over 17 years now. So yeah, regulated with SJB in Europe and also in the US as well. So I have all my SEC qualifications. But yeah, hopefully we can have a bit of a decent chat tonight. And if you've got any questions, obviously feel free to put them in the chat, and we'll maybe speak in a bit.
Excellent, thank you both. Well, just regarding myself, I've been at Lumon for almost 4 years now, working my way through the company, and now here hosting webinars. But you know, Lumon's been around for almost 25 years, and you know, we trade £8-9 billion worth of currency every year through this dealing desk. Yeah, as well as that, you know, I like to keep up to date with what's going on in the world news and economic markets, things like that, to help create content for our market analysts type of side of the business. I'm also a big Arsenal fan, but I won't mention that because we'll be here all night talking about football. But yeah, so like I said, we're here to talk about the recent budget and what might be in store ahead. You know, in terms of the currency aspects, you know, you've seen more of really what could be seen as a knee-jerk reaction after the budget. You saw the pound fall, you know, a couple of cents across the boards against the euro and the dollar, just to name a couple. But it has then recovered. You know, it's been on its surge again, and it's trading close to the best levels in almost 3 years against those currencies. So you know, there are some concerns around growth and investment in the pounds. Inflation's back at target levels, which is something that, you know, in terms of interest rates, you could see the Bank of England move to cut interests maybe sooner rather than later. But yeah, like I say, that's kind of the reaction initially. If either of you want to expand on how that works on the financial side of things, or how that might, you know, impact clients initially.
Thanks, Matthew. Yeah, Rachel Reeves definitely spooked the markets on Halloween. And back to the fireworks again. I'm sure some fireworks went off in number 11. I think the reason for the budget is, if we look at 4 key areas, retailers are plagued by shoplifting. We've got a transport system that seldom works. 6 million people on the NHS waiting list, and we've got housing crisis. So what we saw was 40 billion in higher taxes. The government's looking to spend 74 billion in terms of spending on these different areas over the coming months. So We saw some forecast changes. Keir Starmer's looking for about 2.5% growth in the UK, but the down rates are more likely to be around about 1.5%, which could put some upward pressure on inflation, which could increase mortgages and borrowing costs. We saw gilts rise to around about 4.55% on the back of the budget, but they've settled now down to around about 4.25%. But yeah, a lot's going to happen on Thursday when we've got the Bank of England rate decision. So looking forward to that. Thank you.
Yeah, definitely. I mean, you know, among some of the analysts this week, about 90% chance that we're going to see a 25 basis point cut from the Bank of England on Thursday. So those interest rate cuts are coming. I mean, Daniel, do you have anything to add in that respect in terms of how that might affect some of our clients?
Yeah, well, these things are always going to happen. Obviously, we knew we were going to have quite a, we always knew there was going to be a period of higher inflation kind of post-COVID. We knew that was going to come because that's naturally what happens. Then all of a sudden, obviously the war in Ukraine happened, which kind of created, a perfect storm. Obviously energy, everything like that kind of skyrocketed. That's why we saw, it's the highest inflation we've seen in, 30, 40 years. Obviously, it's good to see it start coming down. What that happens, obviously, for markets, once that does start to come down, that means borrowing becomes lower or costs lower. So essentially, then people start piling money especially into new technologies and things like that. So you will start to see, obviously over the last 12 months, we have seen a very good performance from the market as borrowing started to become less and less. So yeah, absolutely. You're probably going to see some decent performance in the market, but yeah, again, we're kind of resting on what is going to happen with the US elections. That's obviously going to form quite a major role in anything that's going to happen over the next 2 to 3 or even 6 and 12 months.
Yeah, definitely. Well, there's a saying in currency that when the dollar sneezes, the world catches a cold. So I'm sure we'll be watching quite closely with what's going on here. But yeah, we'll move on to some of the questions that we received before we came on today. Some good questions in here. But Robert, I'll start with yourself. We've got a few questions for you. So first of all, it's just around capital gains tax. There's some people here who may have more questions around the changes and how that will impact them, especially on maybe second homes and their businesses there. So if you just want to talk a little bit about that.
Yeah, obviously we've seen some changes in the base rates of capital gains tax. I think the question related to a particular individual who had a residential property but had been out of the country or had let and become an accidental landlord. So there are going to be some changes to CGT in terms of the property market. I think the key thing here is if you look at capital gains tax, to calculate capital gains tax, it's quite a complex calculation. So if you do have any specific CGT inquiries, then I'd just reach out to us and we can help you with it because it's very, very specific to the individual. So you take the purchase price and all costs can be deducted from the sale price. And quite interestingly, we've seen a rise. We've seen increases in the stamp duty, but that can be offset when you actually sell the property if you make a profit. So you offset your selling costs. You can offset any capital improvements. So if you spend money on a loft conversion or you've done up your conservatory, then that can be offset as well. And then you've also got your legal and professional fees that can be deducted too. But don't forget, you've also got the CGT exemption allowance, which is now £3,000. That's per individual. So that comes in quite useful in terms of tax planning. If you've been or if you've let out your main residence, so if you're overseas and you've let out the main residence, then you may qualify for what's called private debt residence relief, PRR, and that would be on the amount of time you've actually lived in that particular property or in your own home. So there are deductions available, and also you could qualify for lettings relief. which would reduce your CGT, which is a maximum of £40,000 for the individual and £80,000 if it's joint ownership. But there's a few things that obviously you need to be aware of. CGT does need to be paid within 60 days, but it is very dependent on the specific circumstances on the property. So if you are a non-UK resident, regardless of whether or not you make a profit or if you make a loss, if you have no tax to pay, and if you're registered with self-assessment, then you still need to declare it. And that's something that we can obviously help you with as well. The property market itself, most buy-to-lets, the smaller private landlords are getting kind of squeezed out the market a little bit. Most buy-to-let properties are now owned and managed by limited companies, and of course they pay a completely different tax, which is corporation tax at 25%. So yeah, it's going to be interesting with the stamp duty changes, 3 to 5% and 7% if you're buying from overseas in the UK. So it could open up a market to look at buying properties abroad as an alternative. So it's an interesting market, but I would recommend anybody with a CGT question or CGT calculations, just get in touch and we can help you with that.
Great, thank you for that. Yeah, I was just looking at, yeah, there was another smaller question around, but I think you've covered essentially what they were asking around. But Daniel, I'll hop over to you for maybe more information on pensions. In this case, it seems there's a couple of questions around pensions here. So first one here is, what is the impact of inheritance tax on private pensions?
So yeah, that was a big one. What's obviously happened over the past week, like I said, we knew that the Kia was basically, there was a kind of a storm looking at what is actually going to happen, where they're going to get all this money from. And, we thought it was going to be from pensions. It was, but just not in the manner that we originally thought. Now, inheritance tax is obviously going to form part, so pensions are going to form part of your estate going forward, essentially now. So going to be subject to IHT. That is as of the 4th of April 2027. I will say that with any announcements that the government make, especially one of this, let's say, magnitude, there is actually a technical consultation which kind of goes through all of the minor details. That did start on the 30th of October. That's for them to kind of go through all intricate details as to how this new law or regulation is actually going to hash out. Now, like I said, that's 12 weeks from the 30th of October. So by the 22nd of January, we probably will have a bit more of a better understanding of exactly how that's going to work. But the current rules as we stand now, so prior to 2027, should anything happen to you pre-age 75, if you pass away before the age of 75, that would previously, you'd be able to pass that on to an individual completely free of IHT. Obviously, it wasn't part of your estate then, and also free of income tax. Should anything happen to you after 75, if you pass it on to a beneficiary, still no IHT in the current form, but that would be paid at income tax at marginal rate. Now, this is the big change that's happened. The new rules post April 2027, IHT will be paid first. Obviously, if there is an IHT bill to pay, so if you've got someone who's already over the 325,000 limit, obviously there's the addition of the residence nil rate band on top of that as well. But if you are an individual who is already over the IHT limits, you're going to pay IHT on your pension. So again, pre-75, should anything happen to you, you're already over your limits for IHT purposes. IHT will be paid. That will be paid by the pension scheme. So that's going to be paid at source. And then the individual, should anything happen to you pre-75, no income tax, but will be subject to IHT. But post-75, that is going to be IHT then income tax as well. So it's a considerable amount of tax that could be paid. If you're an additional rate taxpayer, you could be paying 40% and then 45% of what's remaining. So it's, you could be looking at, 60, 70% of that pension pot disappearing. So yeah, and obviously the 325,000 IHT threshold that was in place and was due to finish, was due to be kind of it was frozen until 2028. Well, that's another 2 years that they've tacked on top of that as well. So that's actually now running until April 2030, that you're still going to have exactly the same 325,000 IHT threshold. So, they really have, Rachel really has come for pensions in this one.
Great, thank you. And I mean, there are some other questions around pensions, so I'll keep on to you about this. I mean, we've got one here that says, is my existing workplace pension in jeopardy?
In short, it depends. I can't really say yes or no. I suppose it depends on the type of scheme that you have. I suppose some of the best questions to ask are, have you ever had this reviewed by an advisor before? Do you know what withdrawal options that you've got when you retire? Obviously, pensions freedom, this was something that came in back in 2015, which essentially meant that everyone from now on would have at least the option to be able to do pretty much whatever they want. I think at the time there was a lot of news around people whipping it all out and buying Lamborghinis and all of that stuff. That was what the government were worried about, but obviously pensions freedom has come in. What that didn't do, though, is grandfather the rule in. So just because it's now an option to take all of your money out of a pension, that doesn't necessarily mean that your pension that you have, some of these pensions may be 20, 30 years old, they haven't kind of brought that in. So you might only have a very limited amount of options with that pension anyway. But do you regularly review the investments that you have with an old workplace pension? More often than not, people don't, because look, pensions aren't the most desirable of things in the world. I totally understand it. It's one of those things that kind of gets put in the bottom drawer, gets left, people forget about it. But a lot of these older style schemes are exactly that. They're very, very old. They're not going to do, most of the time they don't do what you're going to want to happen in retirement. Some of the investments automatically change without you doing anything. It might be something that you've set up at 20, 25-year-old. So the only thing that we would recommend is, having that reviewed by either even just yourself, but more so with an advisor, because they can talk you through and explain, you might want something to happen with your pension and may assume that that's going to happen, but unless you check, we don't know. So, but yeah, don't put it off. Obviously, looking at it, you could have quite a considerable detriment if you get to retirement, want something to happen, and unfortunately, that just isn't the case for your plan. So yeah, in short, it depends.
Yeah, definitely. That's something that, I mean, just getting in touch with you as soon as possible. I mean, specifically for our clients, where a lot of them are moving abroad, maybe full time, to talk to you as soon as possible before they do that, because there'll be different implications for if you're a French resident, Spanish resident, or in the UK. I can see a question's just come in about whether they would have to pay tax in the UK, France, or both if they are now a French national living in France with a pension fund in the UK, for example. So yeah, I mean, if you can talk a little bit more about, or either of you can speak a little bit about those type of implications there.
I can cover this one if you want, Rob. So yeah, absolutely. It is a little bit of a minefield. Tax advice. Look, we have, I mean, I'm one of the French specialists here. This is one of my specialist areas. France is quite a, let's say, unique area. Yes, we know a lot about taxation in France, or we don't profess to be tax advisors. That is one thing. We are absolutely financial advisors, investment advisors, all of that stuff, but we don't profess to be tax advisors. We would always recommend seeking advice from a tax professional. But of course, a lot of our clients have had this professional tax advice. We have to have a good understanding of the relationship between the UK and France. Now, the UK and France do have what's known as a double taxation agreement or tax treaty, which essentially means there'll be no such thing as a double tax. So it's not as though you're going to get taxed in the UK and in France. That's just something that wouldn't happen. Pension income is taxed as exactly that. It is taxed as earned income. So exactly, if you were employed in France and you were on, I don't know, 50,000 euros a year, if you took 50,000 pounds out of your UK pension, I'm sure Matthew would probably convert that across at a very competitive rate. But yeah, once that comes across, that would essentially be tacked onto your income. And like I said, tax is earned income. So that's why we just try and manage that as much as possible. But you wouldn't be subject to tax within the UK for that because you are resident in France. One thing that I will say is people fall foul of, because for your entire life, somebody might have been working in the UK for 30, 40 years, thinking, right, I'm going to retire to France. They move across to France. It's something they want to do. Then all of a sudden they go, right, I'm going to take that 25% tax-free cash that I've always been explained I can take. Well, as soon as you move abroad, unless you're in some very, very specific countries, France not being one of them, you lose that 25% facility. In certain circumstances, you may be eligible for a fixed 7.5% income tax rate. In France, if you do decide to take a large lump sum, there will also potentially be social charges on top of that as well. But that is something that I would be very, very careful of. Like I said, a lot of people have been told about this 25% tax-free cash part of it. That's why a few years ago, they actually changed the terminology from tax-free cash to something which they now call a PCLS, which is a pension commencement lump sum. They wanted to take the tax-free part out of it because it was very, very misleading for individuals. So that is something that if you are considering moving to France while you're still a UK taxpayer, if that is, if you're wanting to use that to buy the property or for whatever purposes, a lot of people that we speak to take that tax-free cash out while it is tax-free if they're still in the UK. They move to France because it's never a good idea to just have money just sitting in a bank account. You're always going to be best, especially if it's something that you might not touch for another 10, 15 years, to have that invested. There's definitely schemes within France that are very, very tax efficient, that are only available to French tax residents. But again, this is something that we help people with. If they're looking to move across, it might be that we give them advice being based in France. Like I said, there's a lot of tax advantages to certain products, but again, all of that, this type of conversation is something that we have with all of our clients.
Definitely, and yeah, exactly. Getting in touch with you as soon as possible really is kind of how it works with us as well. I can see there's a question here for myself around when do I talk to you? And there's always a good chance to have at least a conversation, just so you know really how we can help, especially when it comes to moving abroad, as there's a lot of things that we can get in place. So you don't need to set up an account over in France or Spain to speak to a currency broker. We can talk about the exchange and what options there are for you before we go ahead. We're a fully authorized e-money institution, and we're regulated by the FCA. I'm sure you both know how important that is, and the feature when you're looking at a financial organization and the protection that we can offer. So you can leave funds on this account, and if you need them for months ahead, or even in the years to come, that's something that we can help with. And that's through a method called safeguarding. So it's held in a segregated account under your name. So it's not like in the UK where banks will only protect you for up to £85,000 under the FSCS scheme. It's as an e-money institution, it's held in a segregated account, and you are fully protected for that. So yeah, like I say, holding funds here enables you to take advantage of the rate, and that has great implications and towards your budgeting when looking at properties, or just trying to achieve as many dollars, euros, however much currency you are looking to buy. I can see there is also a question around how can we plan with future needs, or let's say you have a lump sum of pounds coming up in the near future and you're looking to move that abroad, I mean, just an example for you, over the past few months, over the past 2 or 3 months on sterling euro, if you were looking to transfer 250,000 euros, the difference from the highest points within that time to the lowest points is £8,000. That's how much that you would lose if you were doing it at the lowest points compared to doing it at the right points. And that's something that, having that conversation with a currency specialist, it opens that up to you. And there's plenty of ways of doing that. Depends on your specific situation, on what kind of funds you have liquid to you at that time, or like I say, just essentially what you are looking to achieve. That's really what we'll help with, because I mean, if you think about it, let's say you need to purchase a property for 250,000 euros. The process is that you sign up for that property, you put your deposit down, and then from that point you're basically buying a property you don't know how much it's going to cost, because you've not done your currency. Whatever that 250,000 euros ends up costing you, that's what we're going to be doing at that time. But yeah, in that sense, we can help you get more of an understanding around your budgets and how many pounds you're looking to spend, and doing that as soon as possible is invaluable to look at some of the rates. So as well as that, I mean, the benefits of this service isn't just offering cheaper euros than your bank. That is obviously one of the main benefits and why we exist, but time in the exchange is critical, as I said, with that. So yeah, let's have a look at some of the other questions in that case. Actually, yeah, so I'll come back to you, Roberts, because we have one about how do changes affect those of us not in the UK anymore, which is kind of what we've just been talking about there. So some of the recent changes from the budget, how has that changed? People no longer living here.
Yeah, it's there's been quite a lot of changes, and quite interestingly, I had a couple of conversations earlier today about people looking to move to Malta, or another individual looking to see if his pension, what you do with your pension if you move to somewhere like Australia. We've already touched on France. Spain's a different entity as well. But if I just pick out Australia just as an example, really, if we go back and look at sort of pensions, it really does depend upon the UK scheme. And again, ISA's a little bit different, but pensions would probably be the main area to focus on. So with respect to moving abroad, it depends on the benefits or the income options that the pension provider will offer. Different pension providers will offer limited benefits. So we look at different ways of planning, because really you need flexibility of income. In the UK, being a UK resident, you get used to what your daily spend is and what your lifestyle is. When you move abroad, there may be different costs that come out of the blue, so you need a different kind of emergency fund, a different kind of structure, which we can really help you with. We do a lot of goal planning, cash flow analysis, to really drill down on the income requirements. And again, working with currency experts such as yourself, Matthew, it's really, really important to understand the currency market and the impact of changes on the currency. Australia is a really interesting one, actually, because in the UK, your UK pension grows or accumulates tax-free, whereas in Australia it's the opposite. It accumulates with tax. But then when you take the pension in the UK, you're obviously liable to tax. So if you had a UK pension, you're living in Australia, as example, then you would be subject to the Australian tax law. So any income you've got coming in the UK plus Australian income would obviously be taxed at the Australian rates. And the Australian rates are completely different to the UK. In the UK, we've got personal allowance of, I think it's 12,570 from the top of my head. Whereas the Australian market, you've got 18,200 Aussie dollars, which is circa £9,000. And the tax rates are completely different in Australia to the UK. And because we got the double taxation agreement, which Daniel mentioned earlier, it doesn't mean you pay tax twice. What you can do is you can apply for a conversion for your state pension to be taxed at source, whereas your state pension is normally paid gross. So there's different ways of working around it. But again, as kind of international financial planners, each individual will have a specific set of circumstances, and you know, I can give a broad brush approach to it all, and but it's going to be drilled down to the individual, and you know, that's the importance of going through, you know, an in-depth fact find, understanding the process, understanding the risk parameters, you know, loss versus reward, where do you feel comfortable with. So there's so many things that we need to go through before we start to, you know, delve on the advice side of things, to start to give information about what's the best thing to do and, you know, how it all works. Just going back to the pensions, we mentioned that, you know, the change in the pensions in the UK now subject to inheritance tax. Death after 75 from April 2027. We're going to see additional rate taxpayers, which you touched on, Dan. They're going to pay 67% because you're going to get a double whammy in terms of the inheritance tax and the income tax. You know, even a basic rate payer is looking at 52% by the time you calculate it all. So, you know, these type of calculations become really, really key, very, very important when you're looking at long-term planning. If we look at the UK, life expectancy, women do live longer than men, according to the OBR and the national statistics. But, you know, the average male lives, you know, to their mid-80s. There's a 1 in 4 chance that you could live beyond 100. So, you know, the planning side of things becomes so specific and so important, because, you know, the last thing we want to happen, and for you to happen, is that you run out of money because of, you know, you haven't planned properly for the future. So it's so important to talk to us about, you know, these different variations, different jurisdictions, cross-border tax planning, so we can provide you with the solutions that you need as an individual.
Perfect. Well, yeah, I thought I'd just quickly jump on that, because we had a question on the first death in inheritance. So special exemption for inheritance tax on inherited pensions will apply on death from April 2027. Does that mean that we're then avoiding an inheritance tax charge on the first death?
You can pass your pension across to your spouse. You know, you do an expression of wishes and it passes across. It will be dependent on the beneficiaries at the end of the day, and the tax rate will depend on their tax rate after the age of 75. It changes as well if the beneficiaries take it out as a lump sum. But yeah, again, it comes down to the individual. Depends if you're annuity. We could see more of an uptake in UK annuities on the back of that, but I think drawdown and the flexibility, and perhaps looking at, if you are moving abroad, looking at more of an international kind of product to look at the inheritance tax side of things. So yeah, that's hopefully answered the question. I don't know if you've got anything else to add on that, Dan.
Yeah, there's some quite specific rules. Like I said, passing on to a partner falls under, you can pass on as much as you like. Inheritance tax is always based upon its joint life, second death, essentially. But yeah, you'll be able to pass on as much as you want of your pension, but then it will be subject to IHT rules should anything happen to yourself. But I think the worry that we have as advisors is all of this news is coming out about inheritance tax, and now, you know, a lot of people out there were using pensions essentially as estate planning. Yeah, a lot of people, you know, that I'd spoken to in the past have said, right, well, you know, I'm going to leave this pension because maybe I've moved to a new country, been living there a number of years, and the pension here I've got is absolutely fine. So my UK pension I have currently. Oh, sorry, I'm not too sure what's. Can everyone still hear me? All right, I'm not sure what's happening. Okay. So essentially, what we're looking for is we would just want to make sure that it's going to pass on as much as possible. Like I said, people were using it as estate planning, but now that's not going to be the case anymore. Are people going to want to take money out of the pension to kind of reduce any IHT that they might have due? If they take it out, are they going to do that while they're working because they're going to pay the higher marginal rate of tax? It's just created a whole new conversation about when's going to be best to take money out of the pension. But then, as Rob mentioned just a bit ago, are people going to withdraw too much out? and then all of a sudden they get to 85. You know, if I don't know how long it was that, you know, but let's say it's mid 80s that you're expected to live to, from a ONS point of view. What if you live till 95? You know, this is the worry as well. Are you gonna take the money out and start gifting it? Well, if you start gifting it, you've then got to worry about any potentially exempt transfers, all of that from a IHT point of view. So it's basically just become, you know, a little bit of a minefield, because are you going to do something that you can't undo, and then you're scrabbling about for money when you're older, or you know, are you going to not take anything out and then be subject to IHT? Well, it's like Rob said, we've basically got to find a middle ground. All we want to do as advisors is feel like we're providing advice with something that you feel comfortable with. There's never going to be a strategy out there that is absolutely perfect. What there is going to be, though, is something that you feel more comfortable with. So if you get to, you know, if you can survive your entire life, but you know you're going to have a little bit of, or your beneficiary is going to have a bit of IHT to pay, is that something that you'd prefer? Or would you rather run the risk of, you know, well, I'll get rid of as much as possible because I know my IHT is going to be massive? Well, are you fine with completely exhausting any pensions or investments? This is just the type of conversation that we will try and have, just to find out what you feel comfortable with, and then we can advise accordingly.
Yeah, it feels very similar to the kind of well, the extent of which we can communicate with clients. We're not here to offer, you know, strict advice on currency markets or where the markets might go, because quite frankly, I don't know where it's going to go, and I certainly wouldn't be in London if I did. But yeah, it's one of those things that, you know, protecting yourself from anything, from any adverse movements in the rate, for example, or like I say, if you're budgeting towards a specific amount, just removing that risk to make sure that you are comfortable with your decision, and not, you know, gambling with what may happen in the future, and securing yourself. So yeah, it's an interesting one. We've got a couple more live questions here as well. So one of them is, what if I want to take my pension outside of the EU? So for example, Singapore, what will be the impact on that? Either of you?
Are we talking about, well, I think what they mean is if they want to transfer outside of the UK and transfer the pension possibly into a pension in Singapore, maybe.
Yeah, could be.
Well, so if they are referring to that, absolutely, that's something you can do. You can take it outside of the UK. Whether there are schemes in Singapore, unsure. There is actually, if you go onto the HMRC's website, you can actually go onto, you essentially want to look for the HMRC QROPS list. So QROPS just stands for Qualifying Registered Overseas Pension Scheme. You click on that QROPS list, and it'll tell you in which countries there are actual schemes that are available or are out there. It doesn't necessarily always mean that you can transfer to that scheme. Some of them are only set up for kind of workplace pensions for specific companies. So that is something that's worth noting. There was quite a considerable change. Again, Rachel brought in last week, which essentially meant that you couldn't transfer to a QROPS unless you were living in that specific country. And if you went anything outside of that, basically you would pay 25% as an overseas transfer charge. So let's say, for instance, if you are in Singapore and you decide to move that into a scheme that's not based in Singapore, then 25% of your pension would be taken as an overseas transfer charge. That is something that has come in, like I said, last week. We are still waiting for this technical consultation. Like I said, there was a lot of news on QROPS. I assume the new IHT rules will also apply to QROPS as well. But that is definitely something that's worth checking. So, like I said, I'm sure you can have a look at that QROPS list, and you know, if it is even possible to transfer it across. But yeah, that's just something you need to be really careful of, because if you want to transfer to a country that you're not resident in and you can't prove it, then you will pay 25% as a charge for doing that. So that's just something to be really careful of.
Great, thank you. Got one here for Robert, bordering on, well, this is strict advice for this one. So what's the advice for one moving home? Makes sense to sell it or hold it? If I decide to sell, what's the capital gains tax? So see if you can delve into that one.
I love a broad question. There's what's that, 3 questions in that one, isn't there? If we look at the kind of the current landscape, again, this is lead on for what Dan has just said. What we're seeing is an uptake in individuals over 55 taking out their tax-free cash from their pensions. We're also seeing an increase in gifts, and again, gifts takes a lot of planning around that, because it depends who you're gifting the money to. So, you know, there's key considerations here in terms of, you know, looking at, you know, are your dependents ready to inherit money? You know, are they financially sound? Do they like partying? Do they like going out? You know, are they going to spend it all? So there's lots of considerations around that. So what we probably see is bank of mum and dad helping children get on the property ladders. They're probably likely to be more of an uptake in that. Again, coming back to should you sell the property, I think it just depends on the individual, doesn't it? I mean, are they going to permanently move, or are they just going to test the water and then come back if things don't work out? You know, there's quite a lot to think about. And I guess if you're looking to make a permanent move, if it's a property that's going to be liable to capital gains tax, then we can help you with the calculations around that to see if that's viable. In terms of the property market at the moment, despite all the changes, I think we're still going to have a resilient property market here in the UK. I think what we may see is people may look to buy second homes abroad. Whether or not they sell their existing property, again, it depends entirely on the individual, and what their aspirations are, what their dreams are, and how they're going to live their life in the future. I think the key issues that we've got in the UK on the back of the budget, just sort of moving aside a little bit, is we could see some dynamics change in the UK. And if that were to have an impact on the property market, then you may want to consider selling, paying a bit more CGT, but taking a higher sale price. What we're likely to see is, obviously, with the national insurance increases, small businesses may start to lay staff off. With the minimum wage increases, we could see fewer jobs out there. And with the increase in business rates, it could push some businesses under. I mean, this is a like doomsday scenario. I'm talking about the worst case scenario here. But what we are seeing is obviously an increase in technology, and tech is replacing jobs. If you go into a McDonald's, in the older days you used to have to queue up and give your order over the counter. Now you've got all these touch screens, and you very quick and very easy to operate. So what we're seeing is McDonald's are giving a much better service with fewer staff, and that may start to happen across the board. The impacts that these things have, what we could see is with all this change, is supermarkets are starting to consider hiking prices, which could then lead to inflation. The flip side of that is we saw that happen during COVID. Prices were going up in the supermarkets, but stock prices continue to rise. So there's always winners and losers in these different scenarios, and it's about planning and understanding what we call the macros, which is looking at the whole of the situation, taking a very holistic view of, is it worth your while selling that property at the moment? Well, again, I'm not a property expert. I don't know the way the dynamics of the prices go, but we can certainly help you with the CGT calculations. Again, all eyes are going to be on the Bank of England rate decision. There's a high probability that it will be cut, but the budget scares, I'll go back to the Halloween thing again. I'm not on the Bank of England panel, so I can't tell you, 100% sure, and I'm not a mind reader. So we'll have to wait and see what what happens with that. We've also got the elections coming up in America, haven't we? And there's going to be some big changes coming through from that. If Trump wins, if Harris wins, then I think things will remain as they are. But Trump's looking at cutting tax, higher tariffs, lower immigration, which will probably lead to a spike in GDP in the short term, which is gross domestic product. But long term, it could lead to more inflation out in the US as well. So although we're speculating that interest rates may come down in the US, again, it will depend on the outcome of the election. So there's lots of considerations there in terms of, is it the right time to sell? Should we sell? If you're moving abroad, then I think it comes down to the individual and having a very deep and meaningful conversation with that person before making any recommendation.
Yeah, definitely. And yeah, it's quite interesting. The US election this week, may not hear the actual results for a couple of days, but on Thursday we've got the Federal Reserve's interest rate decision as well. So be a lot going on, especially over in the US. What implications that has, because interest rates are a very important part of the currency world as well. If you are looking at purchasing dollars, selling dollars, it's really an important time. You've had the dollar bouncing back a little bit over the past few weeks because, maybe a couple of months ago we were expecting maybe 2% worth of interest rate cuts over the next 12 months, which is quite a drastic amount in interest and the highest out of any G8 economy. That has decreased a little bit, maybe more, 100, 150 in recent weeks, which is, as a result of some of the good data that has been coming out of the US, showing how robust the US economy can be. But as you say, when you have an election coming up, we did some research over the past I think it was maybe 6 or 7 elections for the US. Average movement on US dollar around that time is 6%. And that is a really volatile period for currencies such as the dollar and the euro. Well, I mean, the dollar makes up 60% of all currency exchange in the world. So, it's the most traded currency pairing in the world. And for a 6% change on that currency pairing, that is a really drastic time. Just shows, especially with an election as tight as this, you saw over in France in the summer, you had 3 parties all trying to go for this election, and no one really knew what was going to happen. The euro was falling across the board due to that uncertainty, and it definitely has an effect on the currency markets. And then, as well as that, in the UK, we knew we were going to get a Labour government for a long time, and that was priced into the market for a long time. It's actually one of the reasons we've seen the pounds have such a great, Q2, Q3, Q4 now. Part of that is just the stability of where interest rates will be, what government will be having. That's the kind of thing we can look at in currency markets to see, to look at time in your exchange. So yeah, definitely interesting one this week. So we've got one more question here. I'll put this both out to you. With the high tax NI on employer and adoption of technology, seems unemployment will be high. Isn't this heading to unrest kind, or am I procrastinating? Sounds like one for you, Robert.
When you say it's going to lead to unrest, I'm not quite sure what unrest means. I think there's going to be some disgruntled business owners out there, especially the smaller business. And I think it was on one of the articles I read, and there was a hairdresser in tears because of the changes in NI. Not only that, obviously the minimum wage increases as well. So yeah, it is going to have an impact. With every budget, unfortunately, there are always winners and losers. The pubs will probably do well out of it because we didn't see a hike in obviously the duties there. But yeah, it's a difficult one. Technology, we are seeing an AI revolution. It's becoming more and more prominent. People are using AI more and more. But AI is also designed to help us as humans become more efficient. So, as we become more efficient as well, you can learn about anything within reason, by using these AI chat facilities, and you know, it's really quite interesting, and it's quite dynamic how this is you know, really growing now. So yeah, I think, and when we see unrest, I don't know. I think unrest is, you know, what we're talking about, civil war or something like that. It's a bit of a, you know, a broad question again, but I think we probably will see some disgruntled people. But, you know, hopefully the government's here to protect us as individuals, and, you know, hopefully they can do their job correctly, and, you know, it doesn't cause too much unemployment, because they won't want that. Mass unemployment, you know, causes horrendous problems. So, you know, as a government, that you're looking to reduce unemployment as much as you can. And, you know, they've got back to work schemes and various other things. And I think that's why they've increased the minimum wages, to incentivize people who aren't working to go back to work, but also as well to, you know, potentially entice foreigners to come to the UK as well, because you know, you can earn a decent living now, although inflation is still reasonably high. Well, we've seen it come down, but prices are still quite high at the moment. We haven't started to see prices come down as much as we should do. If prices continue to fall, or do continue to fall, then that obviously helps businesses, so they can start to offset some of that. And maybe that's the government's long-term plan, is to actually really bring down inflation. So although Keir Starmer talks about growth of being 2.5%, but the forecast of 1.5%, if Keir Starmer does it and gets it right, then, you know, small businesses will also benefit from that. So there's lots of different things that, you know, we need to factor into that. And yeah, I'm not an economist, and I'm not a politician, so I don't want to go down this street.
I just want to tack a little bit onto the end of that, just regarding obviously the national insurance increase for employers. I think it's gone from 13.8 to 15%. I think that's what's going to change to. Now, if anybody out there is still in the UK and is still contributing into a pension, sometimes people pay through salary sacrifice, those types of things, into a UK workplace pension. What I will say is it's always worth checking with your employer to see if you make, let's say, additional salary sacrifice, if you make additional contributions into a pension through your employer, well, essentially what that does is, not only is it tax efficient, we all know about how tax efficient pensions are, but once you're contributing into that scheme, obviously, because if you're paying, let's say, £200 a month, well, that's effectively £2,400 less that you're earning per annum, because it comes out of your gross salary. And it's on your net salary is what your employer pays national insurance contributions on. So if all of a sudden they're then now saving another 1.2%, well, they're paying 1.2% more, but if you're contributing more into a pension, then that's going to save them money as well. So usually what an employer will do is, if you up your contributions into a workplace pension, what it might mean is that your employer will then put more into that as well, because that's an incentive for them, because you're earning less, they're then paying less national insurance on your lower salary. So it's a bonus for them as well. So if that's something that you are in the UK and you are, you know, all of these employers out there, it is going to hit them hard in the pocket, especially some of these larger firms, but also definitely the smaller ones as well. If they're contributing more towards the national insurance bill, then if you are doing salary sacrifice or putting money into a pension that's coming off your gross amount, that will then save them some money. So it might mean that they might put a little bit more into a pension as well. So it's always worth looking into. So just a possible little silver lining for individuals out there.
Excellent. Thank you for that. Just got one question left here, and it's for me. Why would I use a currency broker over my local bank? So this is probably the most common question we get. I mean, I can understand it. Maybe it's a little bit daunting when sending to a third-party provider potentially. But you know, there is a reason that, you know, we've been around for 25 years now. And yeah, I think I've touched on a little bit the points of this service. You know, first of all, high street banks are not something, they're not, you know, typically offering great exchange rates, and through our buying power, as I said, £8-9 billion worth of currency through the dealing desk every year, that's why we're able to offer much more competitive rates of exchange. And as I said, with the timing of the exchange, that's absolutely critical for this type of industry. You know, we offer expert information and I guess just general knowledge in the currency world to offer guidance on the timing of the exchanges, and that's just so that you as a client can make it more of an informed decision. You know, the option of going with your bank, essentially just going in blind on what is happening with the currency and whatever they want to charge as a rate, that's the other option essentially. And just to touch on what you said, Robert, in terms of AI and I guess online services, you do have plenty of online services out there, and you know, we do know about, you know, Wise, Revolut, those kind of companies that are very good with their kind of currency exchanges. But speaking to someone over the phone for, you know, a large exchange is quite powerful, I would say. I mean, being able to discuss with them, I guess just being able to get on the phone with someone within a minute or two, as opposed to going through your bank or an online web chat, that's never going to be replaced, really. But yeah, and like I say, being able to plan that together to make sure that you are achieving what you'd like to achieve in the currency world, that's obviously very important. So good. Well, I think that may be it for the questions. I mean, unless there's anything else either of you'd like to talk about in terms of the budget and anything you had planned to speak about that maybe we didn't get around to speaking about.
Not particularly. Rob, I know you've.
No, I think to be honest with you, we covered most areas in the budget, unless we start drilling down into AIM stocks and various other business reliefs. Obviously, farmers are being hammered quite hard. But just going back to what you were saying, Matt, about the currency, I think it's really, really important that you do have somebody that you can talk to. I'll give you an example. I've got internet with, I won't say the provider, I shouldn't really on a webinar, but they've moved everything to, you can't call them. Everything has to be done through these little AI chats. And the AI chat did get quite interesting. They didn't solve my problem for about a week, so I had no internet for a week. But it was a really difficult thing to do, and it's so important to have somebody there at the end of the phone. I believe, you know, I grew up in an era where everything was phone based, and you know, you speak to people, and I think that's the key to especially with large transactions. Smaller transactions, perfect for AI, but you're talking bigger transactions, property purchases. Certainly speak to an individual, especially someone like Matt.
Yeah, definitely, and like I said, the same goes back to you. I know we've collaborated quite well, and that's yeah, it's very important to speak to you know, wealth managers and make sure that you have everything in place, especially before you move abroad, or if you are moving back, or just any kind of transaction overseas, so you have an understanding of how things will work on either side. It's a good collaboration there. Yeah, and like I say, I mean, if either of you have any closing remarks on anything that we've spoken about today, or just any advice for those in attendance, it'd be great to hear.
My only advice is, if you do have a financial planning need or requirement, then reach out to a qualified, regulated financial advisor such as ourselves, and we can bespoke and tailor that advice around you. And it's really about the importance of understanding what your goals and your aspirations are, and those goals and aspirations will change over time. And you know, with longevity and life expectancy, it's about having a financial advisor and a financial planner that's going to be with you for many years to come. And we've got such a higher staff retention rate at SJB Global. I think it's around about 98% or something like that. It's really, really high. I think we've had one person leave, and you know, that's over a number of years. And you know, we're a happy team here, a happy family, and we all get on well. We all help each other, and you know, hopefully that gets shared with our customers. And we have you know, fantastic reviews on our website, and I think about 95% of our reviews are 5 stars. So yeah, we'd like to think we're doing a good job for our clients, and we welcome any questions that you might have offline. And thank you very much for attending.
Great. Perfect. Well, yeah, just to add to that, I mean, you know, I've only been here for maybe 4 or 5 years at Lumon, but as I said, you know, we've been around for almost 25 years now, and actually some of my colleagues have been here for about 20. We went out for dinner to celebrate their 21st anniversary of being at the company. So yeah, it's one of those things that, you know, you stick around in these type of industries for a long time, and just the wealth of experience between, you know, Lumon and SJB Global is it's a great collaboration that we have going on here. And like I say, speak to them, speak to us if you do have a need coming up, and we'd be more than happy to help with that. So I'll leave it at that. We'll, like I said, we'll send around the contact information and the recording of the webinar if you did miss something and you just want to speak or just have a watch of it again. Please do feel free to just send any questions across as well, and hopefully we'll hear from you soon.